Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at VRT, or Vertiv Holding Co. VRT engages in the design, manufacture, and service of critical digital infrastructure technology that powers, cools, deploys, secures, and maintains electronics that process, store, and transmit data. Here's the barchart.com technical opinion rating for VRT. The bar chart rating is a 100% buy with an average short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. The market is approaching overbought territory. Be watchful of a trend reversal. According to Prime Trade Select rules, a stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that VRT is well above the moving average line, so the monthly trend in VRT is up. Now we're going to look at a daily chart. The stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line crossed back above the green line in May, so the daily trend in VRT is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. VRT is below the upper Keltner channel line, so VRT is inside the buy zone. Since the trend is up, we want to buy a call. VRT has plenty of option chains to choose from. We're going to use the February 16 option chain. Right now, the Feb 16 options have 34 days to expiration. Here's the VRT option chain for Feb 16. VRT closed at 49.52 on Friday. That means any calls on the list from 25 to 47.5 are in the money. Let's take a look at the profit potential for purchasing the 50 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 50 call is 255 to 265. We tried to enter at the midpoint, so we'll use 260 as the buy price. Our call option calculator shows the profit potential for this call based on VRT price changes at option expiration from flat to a 12.5% increase in price. We can see that if the VRT stock price is flat at 49.52 at option expiration, the 50 call will lose 100% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out our trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 42.5 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 42.5 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the VRT stock price is up 1%, the 42.5 call will lose 3% of its value. We want that to be break even or better, so the 42.5 call does not meet our requirements. Let's see if the 35 call will work. The bid-ask spread for the 35 call is 14.10 to 15.10. We try to enter at the midpoint, so we'll use 14.60 as the buy price. The 35 call works. If the VRT stock price is up 1%, the 35 call will make a 2.8% or $42 profit. That's better than break even, so the 35 call is the one we'll buy. The call option purchase calculator also shows that if the VRT stock price increases by 2.5%, the 35 call will make a 7.9% or $116 profit. If the VRT stock price increases by 5%, the 35 call will make a 16.4% or $240 profit. If the VRT stock price increases by 7.5%, the 35 call will make a 24.9% or $363 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the VRT stock price does not make the expected move up and it remains flat at expiration, the 35 call would only lose minus 0.5% or minus $8 compared to the minus 100% or minus $260 loss for the 50 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the VRT February 16 42.5 strike call and sell to open the Feb 16 47.5 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 42.5 call for $7.75 and sell the 47.5 call for 4 even. 7.75 minus 4 even equals 3.75. So the entry price or debit cost for the spread is $375. The call option spread analysis calculator picture shows that the spread will make a 33.3% or $125 profit if the VRT stock price declines by 2.5%, remains flat, or increases in price when the options expire. If VRT is down 7.5% at expiration, the trade will lose 11.8% or minus $44. Creating the debit spread will allow us to collect a $400 cash credit to our brokerage account for the sale of the 47.5 call. As we said on the previous slide, this reduces the cost of entering the spread to $375. Here's a note regarding earnings reports. The next VRT earnings report is scheduled for February 21. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the VRT February 16 35 strike call for $14.60. We also reviewed a spread. The spread said to buy to open the VRT Feb 16 42.5 strike call and sell to open the VRT Feb 16 47.5 strike call at a debit of $375. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.